somebody has a home in Bucks County, a seashore home in Brigantine, maybe Margate, and then a winter place in Florida. How do people deal with finances in a scenario like that, Paul?
Yeah. So, a lot of people, if you have equity in your house, in your situation in Bucks County, the first thing is they're going to look to do a home equity line of credit or a cash out refinance. So you can take equity from your primary residence. You can borrow up to 80% of whatever your primary residence is worth, less your mortgage if you have one. So if you don't have a mortgage on your current property in Bucks County, you can borrow 80% of that appraised value. So, if you have a house that's worth $400,000, you can borrow up to $320,000 of that value. You can turn around and buy something cash down at the shore, or you can take that money and apply it as a large down payment to purchase something in the second home market, whether it's the beach or whether it's Florida. Interest rates, unfortunately, are elevated for second homes compared to primary residence. However, when you're putting that much money down on a property, so if you can get to 30% down or greater, the rate adjustments are not that significant for a second home. So, we definitely see a lot of second homes with 50% down. I'm closing one tomorrow in Brigantine. Borrower bought the top and bottom floor, and in both scenarios, he's putting down 35% on each unit. So it's a great opportunity if you have cash in your house. And remember, when you do a cash out refinance on your primary residence, there's tax implications that come into play, and there's a write-off that works in your advantage in doing something like that.
In your experience, Paul, from rate.com, are the builders offering to buy down points? Is that common down the shore?
So I don't know so much down the shore. What happens if you have a property sitting on the market, a builder has a property and it's sitting on the market, he can offer incentives, right, to be able to do what's called a 3-2-1 buy down or a 2-1 buy down. So what that does is that builder says, okay, we're going to give you $20,000 in a seller assist, and you can use that money for whatever you want. You can use it to reduce your closing costs, but we really want you to use it to do that 3-2-1 buy down. And what that means is, let's say today you're buying a property down the shore and your rate's 7%. The first year, it's 3% lower. So the first year, it's going to be from 6% to 3%. The second year, it's going to go from 3% to 4%. The third year, it's going to go from 4% to 5%. And then back into year 4, it's going to go to its original rate. And what that does is it gives the buyer the ability to be able to buy that property knowing that he's got a 3-year relief on his interest rate to lower his monthly payment. The thought process is when the Fed comes in and lower rates, that client has the ability to refinance out of that at some point.
Is it possible that here in 2025, we might kind of dip our toe into the 2008 problem or crisis back then? Are we seeing any similarities, or is that just a bunch of hot air?
Yeah, I mean, that would be more, I think Sherry would have a little bit more of a handling on that. I don't think we'll ever, knock on wood, get into that 2008 crisis where borrowers basically were underwater, where their house wasn't as worth as much as they owe. I don't think we'll get into that crisis. I think what would help that is just having lower rates in some case. But personally, I don't think we'll see that time frame again. Knock on wood, hopefully we don't. I would love to see the 3-4% interest rate that we saw during COVID. It was just an opportunity where people had, I don't think I would ever in our lifetime see an interest rate of 2 to 2.5%. It was a great run.
What about downsizing and layoffs? Do you see the home marketplace changing because of job loss? Interest
rates, obviously we talked about in the 10-year treasury is what really has a good indication of where rates are going to go. But one of the biggest indicators are job numbers, jobless claims. So the more people that are unemployed, the job losses, unfortunately, it lowers interest rate, right? The uneasy or the uncertainty of what's going to happen. But, we have jobs numbers that come out that have a major impact on interest rates. So the more people are unemployed, the lower we're going to see interest rates in some cases.
The stock market's been fairly hot as of late. How does that play a role with people purchasing a home? The stock market, how much of a role does it play when you have somebody calling you to get some financing?
Yeah, the stock market, when the economy's showing signs of improvement and things are doing well, is when we start to see interest rates can sometimes, in some cases, rise, right? So negative history in the industry will lower rates, whereas positive stuff will absolutely, will raise rates. The market's been this way for pretty long time. I mean, it's been it's been elevated. So we haven't seen a major change, but I think what will have a big impact on us is basically going to be the unemployment. But also, I think when the current administration continues to put pressure on the Fed, and when the Fed changes over next year, when Powell moves on, I'm really curious to see who's going to take that spot in Powell's replacement. It's going to be interesting. So,
are some people cashing out some of their holdings in their stock portfolio? Do you talk to people about where they get their funds, or is that part of the process that a mortgage broker typically always does, and find out where you're getting that cash from?
Yeah, so I talk to people all the time about putting cash down and so forth. Does it make sense to liquidate some of your portfolio? And really, for me, that's a financial advisor's question. But a lot of times, if when money was cheap, when money was 3% or 4%, I was advising people to put as little down as possible, right? Because you're borrowing at such a small clip. If you put down less than 20%, you have mortgage insurance. But when your rate's 3% and you add a little bit of mortgage insurance, it's not the end of the world, right? As rates are as rates are higher and elevated, I'm seeing more and more people get to that 20% down or greater, whether they go to their retirement. What a lot of people do is, the people are buying property without selling their current residence, because you can't put an offer in contingent on the sale of your house in this market. Very unlikely that any seller is going to say, hey, we'll accept your offer, even though that you have to sell your house, right? So the contingency offers are tough. So people were putting an offer in, holding on to their current house, buying the new one, then selling their departing residence. Now they have all this money in their hand, right? So what they do then, instead of doing a refinance, they do what's a lot of investors allow you to do a recast. So after you sell your departing residence, you can give us a percentage of money. It's got to be $10,000 or greater, and we'll keep the same interest rate, lower your balance, reamortize your payment, and gives people the ability to buy with holding on to the other property.
All right, maybe one of the most important questions for Paul Zgalich of Rate.com. Blues, striper, fluke, kingfish. What's biting right now in Brigantine?
So you got a little bit of everything right now. I think on the surf, you got plenty of kingfish. You got spot. You have fluke. I think the bluefish are definitely something that are gone. They're moving their way up north. Stripers are gone. You won't see them until the fall.
It's good season, though, huh? Good season, right?
It's tuna time. That's what we're going to be focusing on. So I'm looking forward to getting out and doing the Jimmy Johnson next week.